Starbucks, stock ticker SBUX, is currently trading at $86.59 per share. Now we can see year to date they're down almost 26%. And if we jump into my do-it-yourself investor toolkit and zoom in a little bit, we'll come over here and look at my growth chart. But you'll see this is actually a position I'm up about 10% on so far. If we jump back over to Seeking Alpha, we can see earlier this year they were trading around the $70 to $75 range, and I actually performed a stock analysis on them during that time and decided it was a good time, and it's worked out very well for me this far. But with their next earnings date coming up, we're going to be jumping into my stock valuation spreadsheet to see if this is a good stock to consider buying or selling. We're going to be looking at 4 different valuation models. We'll be looking at Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet or any of my other spreadsheets, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here, and we're just going to go ahead and plug in Starbucks' ticker and hit enter. And you can see all of this data is going to automatically load in. So there's been a huge decline in their share price as we saw. And if we come over here and look at the dividend data, we can see they're paying out about $2.12 per share currently, which gives them a dividend yield of 2.45%. Now their payout ratio, 53%, a little bit higher than I typically like to see it, but still a decent payout ratio. Now coming down here, we can see analysts currently have a target price of $96.55 per share, institutional ownership decent at around 70%, and a beta of 0.89, so you're not going to see a whole lot of volatility with this stock. But let's go ahead and jump into our first valuation, and that's going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors. And here's the formula he lays out for us to calculate intrinsic value. And there's 3 main drivers that are really going to help you arrive to what your intrinsic value is. And the first one is going to be your earnings per share. Now, Starbucks has been growing their earnings per share over the past decade by a decent amount, currently sitting at about 3.56. We then multiply that by 7, which is the price to earnings of a company with no growth. And then we apply our growth rate projection. And analysts typically have a lot of different growth rate projections for Starbucks, but I think they still have a lot of growth in their future. So I'm applying a growth rate of about 11. We then multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we've done all of that, we need to divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it's sitting at a very high 5.1. And that's really going to lead to a lower valuation. And that's due to the current market conditions. So when we plug all of this in, we can see we come to an intrinsic value of around $55 per share, quite a bit lower than that current trading price. Now let's go ahead and move forward and look at our discounted cash flow model. And the idea behind a discounted cash flow is you should be able to value a company based on how much free cash flow they are going to be producing in the future. So to get the growth rate for the future free cash flows, you can see I plugged in the historical free cash flow for this company so we can see our year-over-year growth rates, and it's fluctuated quite a bit, but overall over the past decade, they've done a really nice job of continuing to grow their free cash flow over time. We can see average growth rate pretty crazy, but that's because we've seen some pretty crazy drops we can see here in 2019, 2020, and 2021. But overall, I think again, a growth rate of around 11% for their future free cash flow is going to be pretty close to accurate. So I projected that to the future free cash flow and the terminal value, which is the sum of all the future free cash flow past the year 2030. I then took the present value of those future free cash flows and added them together here, added the company's cash and cash equivalents, subtracted out their total debt to get the equity value as we can see here. I then divided by the number of shares outstanding, and this brought me to a discounted cash flow price per share of $100.88 per share. So let's go ahead and jump over to our multiples valuation. And the idea behind our multiples valuation is we should be able to value this company based on how the market is valuing similar companies using a multiple such as our price to earnings multiple. So you can see I'm taking companies that have strong brands such as McDonald's, we're taking Yum and Domino's Pizza. We're taking their stock price, dividing by their earnings per share to get that price to earnings multiple. We then take the average price to earnings multiple of these 3 companies, and we multiply by Starbucks' earnings per share, and this gives us an intrinsic value of $95.46 per share. So what does this mean? Well, we can see the average price to earnings of these comparable companies is sitting at 28.28. If we jump back over to our stock screener, we can see Starbucks' price to earnings sitting around 24.35. And something that I think is interesting is obviously that is a bit lower, but you'll see that is closer to the numbers like Yum and Domino's Pizza. McDonald's obviously has a really strong brand. I think it's fair that they trade at a little bit higher of a price to earnings multiple, but I think you could make the argument that Starbucks is also a very strong brand and continues to increase their free cash flow and dividends. So I think they do deserve a higher price price to earnings multiple than these two companies listed right here. So again, maybe a little bit undervalued according to our multiples valuation. But let's go ahead and look at our last valuation, which is the dividend discount model. One of my favorite valuations to look at because it values a company based on how much they pay out in dividends and how much that dividend is increasing over time. And Starbucks actually just raised their dividend by 8.2%, which is going to be 53 cents per share. So if we jump back over to our dividend discount model, you can see I'm reflecting that here. I've also listed the historical dividend payouts for this company so we can see how much they pay out each year. And this allows us to see our year-over-year dividend increases of 13.89, 9.76, 8.89, and 8.16. So really good dividend growth from this company. That's an average growth rate of about 10.17%. Moving forward, I'm projecting a growth rate of 6.5% and a discount rate of 8.5%, which gives us a dividend discount model price per share of right at $113. So when we jump over to our output tab, we're going to see all four of our valuations: Grams at 55, multiples at 95, discounted cash flow at 100, and dividend discount model $112 per share. So we do have a little bit of an outlier with Grams valuation. Again, a huge part of that is because this current yield on AAA corporate bonds is driving this valuation down. But when we average all four of these valuations together, we still come to an intrinsic value of about $91.13 per share, which is a decent bit above the current trading price of this company. So if we apply a margin of safety, let's say we apply 10%, we can see our acceptable buy price for this company is around $82 per share. So it's not quite in that buy range at the moment. But even if you think Grams valuation isn't as fair of a valuation due to the current yield on AAA corporate bonds, let's say we remove that out of our valuations, we can see we actually come to an intrinsic value of $103 per share with an acceptable buy price with a 10% margin of safety of $92 per share, which would mean it is now a good time to buy the stock. So for me personally, I would actually love to see the stock go a little bit lower after their earnings comes out. I would love to buy some more shares at the price that I bought at so I can keep my high growth rates. I'm already up around 10%, and again, I'd like to add more shares, but go ahead and let me know what you think of this company down in the comments below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.